The lifestyle that you will live in your retirement is dependent on your financial decisions. Whether you will live a luxurious lifestyle with expensive travels and homes, or live a harder life with constant stress about your retirement funds is dependent on whether or not you made the right choices. Hi, welcome to Grayson Finance. For today's video, we're going to talk about what mistakes to avoid to help you achieve the retirement you deserve. We all want to enjoy the sweet fruits of our labor when we retire. No matter how much we love our jobs, we always look forward to the sweet retirement waiting for us at the end of our careers. In order to get the retirement of your dreams, however, you need to plan it as soon as possible, which means that no one is too young to start planning their retirement. Planning very early means you have more time to invest and will have a better approach to uncertainties. When you save as early as possible for retirement, you will have a better financial capability to address healthcare prices and inflation rates. Even with starting early planning and saving for retirement, however, if you make mistakes on your path to it, the lifestyle that you will live can be a life full of tight budgets and stress. So, in order for an early retiree to be successful on the path to retirement, realistic plans should be made, and you should never make the following mistakes. Number 1. Not planning retirement step by step. Your retirement plans will be bound to fail if you carelessly pick a random age and work for a goal of a certain amount of money. Your good life during retirement will be unattainable because your plans are like this, very far from reality. Unless you phase out the entire process of retirement and little by little, at the final years prior to your goal retirement age, switch to a job less demanding than your full-time job, then you may suffer from potential psychological or financial gaps that will heavily affect your retirement. If you want a better retirement plan, let's take for example if you're a 45-year-old employee with an annual income of $100,000 and your goal is to retire at age 55. To make your monthly benefits substantial, do not just quit entirely at age 55. If you do, all expenses could have been carried alone by your retirement savings until you actually become qualified for Social Security. If you draw Social Security 5 years after you become eligible with an above-average salary history like yours, you will be able to enjoy $31,000 annually from age 60 to 63 for retirement benefits. However, you need to be able to at least earn $50,000 annually from age 55 to 59 to enjoy substantial benefits for your retirement. Number 2. Only having one stream of income. Early retirement won't be as easy as you think it might be. If you wish to maintain a lavish or proper lifestyle during retirement, that means you need to have multiple incomes and rely on your investment options and savings during your retirement. With you planning on these multiple resources, inflation should always be kept in mind. Pension is actually not adjusted just for the inflation rates. Social Security benefits, on the other hand, are adjusted for your growing Medicare costs from inflation. To ensure that your money continues to grow even with inflation in the future, invest your money in assets like real estate. If you don't claim your benefits after 62, there's an 8% higher payout for you. However, in 401k or IRA investments, you're only allowed to withdraw when you're at the age of 59 and a half. If you do withdraw before this set age, your withdrawals will have a penalty of 10%, and this will negatively affect all your financial earnings and savings. That is why you will need a perfect retirement plan that will include multiple income sources that can become your main income source before you reach the age of 59 and a half. These other income sources may come in the form of part-time jobs, investing in stocks and bonds, real estate rentals, and others, and will be a good addition to your retirement savings. If you're seeking an investment that will continue to last long after retirement, then you may opt to invest in stocks or growth options. Successful investing on this matter, however, can only happen if there is a history of stable performance on the stocks. There is always an ever-present risk of a market downturn that will affect your assets heavily because of the sequence of return risks. So the money you should invest in stocks should not be your retirement savings, but the money you can afford to lose. During market downturns, to maintain your goal income, you will need to withdraw from decline value accounts, which means you will need to liquidate more assets. It is necessary to plan multiple streams of income based on the market conditions and be flexible with your withdrawal amount annually from an investment account. Don't forget that investment withdrawals from IRAs can have income tax and penalties when it is withdrawn before the age of 59 and a half. Number 3. Mismanaging Social Security benefits. While it is good to wait for as long as you can before taking your Social Security benefits, for retirement, there may be a risk of compromising reliance on your financial assets. Sure, you can receive better benefits if you don't take it early, but it's not really advised to do that. There may be instances that will make the option of taking your Social Security benefits early better than taking it late. An example of that instance is when you're in a job where the work heavily deteriorates your health, and your earnings are equal to the amount of work you've put in. When you start collecting benefits early after retirement, you will be able to get paid higher money during the times that you might need it more. If you wait long for these benefits to go higher and risking the chance that you might not make it past 80, then these funds will only be wasted as they are also non-transferable. You should choose a reduced monthly payout rather than not enjoying any payout at all in your life. There are also more reasons why people take benefits early. First, you will need that monthly benefits even if it is low because you don't want to pay your expenses through savings and end up depleting it all. Second, if you've reached 62 years old and the money is needed for the earlier days of your retirement. Lastly, your income requirements require that you will need to withdraw from your retirement account for more than 5% of your total to be able to prevent savings depletion. Number 4. Overlooking health expenses. At 65, you are covered by Medicare as your health insurance. But if you retire earlier than this age, there might be problems that will arise as you're not completely covered by insurance in your company or Medicare. One of the ways to get through this is when you have a spouse still working after you retire early, join their health insurance. There's an act called Affordable Care Act that provides every state's healthcare exchange option temporarily, and tax credits for your lower retirement income will possibly include assets to offset premiums. One of your choices to consider is direct primary care, an alternative health insurance model that will give a flat monthly charge for any routine primary medical services. However, the recommended way is that before taking early retirement, you should avail of long-term insurance as the premium increases as time goes by. It is also not suggested to spend so much on health premiums while you are still in good shape and in the early stages of your retirement. It is best to use your insurance when you get older, as it is in those years where the effects of growing older will cause your body to need extra care, with or without relying on the government Medicare policy. Regardless if you have both supplemental cover and Medicare, you will still need to pay for insurance deductibles, and there can also be medical procedures that are not included in your coverage. Optician services, dental care, and hearing aids are also not covered by Medicare or insurance copays. It costs a whopping $285,000 for an average American couple to afford retirement health care without the inclusion of long-term care services. Medicare actually only covers 80% of your healthcare costs during retirement, and to make up for the remaining, you can either buy supplemental coverage, take money from your savings, or remain healthy. Designating extra funds for healthcare retirement costs will make you enjoy retirement comfortably. Number 5. Not considering your legacy in your plans. Even with old age, 40% of elderly parents still provide financial support for their children that are already adults. The financial burden for an early retiree may become unbearable, especially when your children are younger, which makes them more dependent. Having multiple children to support can cause you to commonly spend thousands of dollars monthly. That's why before retirement, you should talk to them and establish the financial support you can afford to give as you get older. This will help your financial plans be kept away from threats of more money requests. You will need the assurance that you are financially stable when you retire. All these financial mistakes should be avoided at all costs to enjoy a stable future with financial stability. Thanks so much for watching. If you like this video, make sure to press like, subscribe, and hit that notification bell to keep you posted on new helpful videos.